Hello and welcome to Investing with Beauchamp and Bright, IG's financial podcast. And this week I'm delighted to say it is actually Investing with Beauchamp and Bright because I am rejoined triumphantly by Aaron Bright, IG's assistant portfolio manager, who has returned from his, I can't call it sabbatical, from his time off due to injury. Aaron, it's a delight to see you back again.
Thank you. Very, very good to be back.
And what happened? Give us the full rundown.
Well, I was mountain biking, not quite in the Himalayas, as you sort of alluded to last time round.
It up slightly too much.
It was only an Epping forest, but it was still quite hilly and caught a bit of rough terrain and went flying over the handlebars. Did a few rolls and then bike landed on my thigh, and then a lot of blood, and then I couldn't move my arm, so I went to the hospital, took a few x-rays, and they said, yes, you've fractured your, well, if there's any medics listening, your radial head and neck, which is basically the bone by your elbow. So having difficulties twisting my palm and extending my elbow, but it is getting better, and it should be fully back to normal in the next few weeks, hopefully.
You weren't by yourself?
No, I was with a friend, and he sort of took me to hospital, picked up the bikes.
I was going to say, were you blue lighted to hospital, or did you?
No, we actually were in the middle of the forest, managed to get back to a pub where we had lunch. There happened to be a lifeguard in there who had a look at my injuries and was like, yeah, you definitely need to go to hospital. I think you might need stitches on the cuts and your arm looks broken. And we managed to get an Uber back to our cars. I obviously couldn't drive. And then my friend, luckily I was with a friend, and he took me to hospital about half an hour away. So it worked out quite well. I was very lucky.
And then how's it been going since then? It's getting back use of it, or?
Yeah, slowly getting back use of my right arm. I'm still brushing my teeth with my left hand, eating soup with my left hand. So I have had to learn to do things slightly differently, but it's, as I said, it could have been so much worse.
Is it typing one-handed as well?
Well, it was at the beginning. I can now use both, and I can now use a mouse. So yeah, but it could have been so much worse. So I'm grateful that it was just something which, is a pain, was quite painful when I did it, but it is healing, and it's thankfully not a life-changing injury.
We are so pleased to have you back. Of course, Martin Harris did so well last time around, stepped valiantly into the breach to talk about NVIDIA, but we're so pleased that you're back.
I'm delighted to be back, Chris.
Normal services last resumed on the podcast, so that's great. And apart from that, small incident, how was the rest of your week?
Yeah, it was good. It was good. I've been it's first time back in the office in a couple of weeks. I've been advised by the orthopedic team to sort of keep my elbow nice and still and away from bustling people on the tube. So good to be back in the office and get back to my sort of daily schedule. What about yourself, Chris?
Not bad. Reasonably busy week last week, of course. What do we have? The ECB. Not changing rates last week, but certainly I think laying the groundwork for that. And then we're heading, of course, central banks really. But from a work perspective, back to normal. I think September's here. It's slightly quieter on the earnings front, but most markets back to normal, really.
I find that around September, October time, I'm just inundated with people wanting to either meet, or there being sort of events from other companies, external events. So it's a really, really busy time, I think, up until December now.
Yeah, it's very much sort of new year, new start almost once you've had August. It's remarkable how quiet markets are most of the time in August. You get the occasional burst of volatility like we did have. But aside from that, it does calm down dramatically, and you get Jackson Hole, and then normal services resumed, really.
Mm-hmm. So one thing that has caught my eye in the past sort of couple of weeks, I'd say, is what's been going on in the yield curve. And I thought, who better to give it and explain in 30 seconds than Mr. Chris Beauchamp on what the yield curve is.
You're most kind. The yield curve, as you know, or should know, bonds have a yield. When you're investing, you get a yield for investing in them. And traditionally, the yield curve rises as you go further out. So you have 2-year bonds that have a yield, and as you go further up the curve, 3, 5, 10-year bonds, the yield becomes more, because the longer you hold it, the greater you want your return to be. Yield curves invert when that relationship is reversed. So you get an environment where the yield on the short-dated bonds, say the 2-year, is higher than that for the 10-year. The basis being that investors are expecting lower interest rates because of a recession, because of a need to cut rates to stimulate the economy. And so you have an environment where what they call the 2s, 10s, where the yield curve made of the 2-year versus the 10-year actually trades in negative territory. Now, this is really interesting because, bear with me on this, usually it's viewed as a recession signal. When the yield curve inverts, and this was covered extensively over the last few years, it means that a recession is on the way. If you look at history, if you graph the yield curve against recessions, you can see when it sort of inverts, it starts the clock ticking to a recession. It actually isn't when it inverts that you've got to worry. It's what's happened now, where it's uninverted.
Yeah, absolutely.
And so when you have an uninverted yield curve, it really shows that you've gone from sort of flashing amber on a recession to saying, yes, one is very close. So that's why this has been so important, I think, for the moment.
I mean, I guess it can be argued that this sort of disinversion is that sort of front end coming down on the basis of rates coming down or imminent rate cuts.
Yeah, and hoping because you've seen inflation in the US has come down dramatically from where it was, you can argue that the factors that drove that big rise in inflation from 2021 onwards have now abated to an extent, and that the Fed is justified in beginning to cut rates.
Yeah.
I think the interesting thing at the moment, what we'll come to in a second, is what the Fed will do this week. But of course, it usually means if you get lower interest rates, it tends to stimulate the economy. And we were looking back to 1995, I think it is, and Alan Greenspan, who's viewed as the godfather of US central banking, the man himself who presided over this era of low inflation and economic growth through successful management of US interest rates. And this is like what they're hoping to emulate with, get that fabled soft landing. Again, maybe you can tell us what a soft landing is.
Yeah, well, sure. I mean, that was a fantastic explanation on the yield curve. A soft landing is getting oneself down from a higher inflationary environment without destroying the economy at the same time. So it's easing the inflation down without hiking rates too much that you cause economic distress, unemployment, and all sorts of things like that. You can kind of, the term soft landing obviously comes from a plane, whether it lands, hard, very hard, and you get a very uncomfortable landing, or a plane sort of comes and onto the runway very nicely. And obviously we want the economy to have that soft landing.
We do, and that's what people say about the Fed is always it hikes until it causes a recession, and which is slightly unfair. I think it's a characterization of the central banks that they are designed to almost to spoil the party. If you like, the economy has been growing, people are getting more wealthy, essentially. Everyone has a job, and then suddenly it's spoiled by those nasty people at the Fed wanting to cause a recession because the economy is running too hot. And of course, this isn't really true. I think that very much a focus not just now on inflation, but also on employment. And you can argue that the fact that you've had a decline in the growth of inflation, shall we say, because inflation rarely declines or deflation. And then you've also got the weakness in the US labor market, which, if you remember, before your injury, if you can remember to that time, you had that shocking payrolls report back at the end of beginning of August, rather, that said that the US economy was suddenly showing a dramatic slowdown in the pace of growth. And it was kind of followed up next month.
Just on that point, it was also worth noting that there was also a revision in the NFP data, a downward revision, which I remember I looked at that initially and I was thinking, crikey, this is quite concerning, because is the data which hasn't been revised yet, which was, I believe, from March, how bad is that data? How wrong is it? Is it, have all those jobs been added?
Yes, exactly. And that was really sent the shockwaves. But it's cleared the path for the Fed to cut rates. So the aim is that by loosening policy, bringing it down from its arguably quite restrictive level, that you will have given the economy more runway. Let's try and continue with the airplane metaphors at this point, to continue to expand without moving at too fast a pace. I think that's the key thing. It's almost the pace of travel that we're looking at here. We don't want the US economy to run away with itself. We want it to expand steadily, and there's just a little bit of weakness in the job market. And by easing rates, the Fed's goal is to say, we want this to continue to expand. We want the Americas to continue getting jobs. I think this was Ben Bernanke's point from the previous when the financial crisis, was that if you look at the US economy and the people who get jobs, the people who always get jobs last in a recovery are the ones that need them most, if you like. And it's the Fed's goal is to make sure that those people get back into the economy as well, because it's good for them, it's good for the economy. So they clearly don't want to spoil the party by keeping rates too tight. The problem, of course, is that you don't want to cut rates too quickly because you might.
That's the thing. If you're too aggressive, you have this sort of double whammy of inflation coming back again, which no one wants, because then we have to go back and then hike rates, and then it's this sort of vicious cycle of, well, then do we cut? Do we hike? It goes on and on and on. So absolutely. I read something really interesting this week, and it said Jerome Powell's at quite an important part of his career in terms of being a central banker, in terms of how much does he cut now? Does he cut the 50 basis points and, we have that risk of there being elevated inflation? Do we do the 25 basis points, but then is it going to be enough if the economy is weak? So he's really got to find that balance, and he really needs to think closely with his team of colleagues at the Federal Reserve how much they need to cut without causing anything to break. Because I think this article said that he has the potential to go down with the likes of Greenspan if he executes this soft landing, given how tricky this inflation was with Ukraine, with COVID, and various other geopolitical issues going on throughout the past few years.
Yeah, he has a potential here to be one of the luckiest but also most effective Fed chairman in recent times to have responded. Arguably, they were too slow. I think it's probably fair to say to respond to inflation on the way up. But there were some people who said they should have cut 25 in July. So you might argue they're a tad late. But given the range of outcomes, I don't think they've done too bad. It's important to understand the central bankers don't have a crystal ball. They're not better equipped to see the future than anyone else. They have a lot of data. They have a lot of very smart people to crunch that data, but they are still taking those decisions in real time. So it's easy to say, oh, they've done this, they've done that, they should have done it this way, but they are still facing that uncertainty that any investor or trader is looking at the future says, well, I don't know what's going to happen next. I have to take a decision based on balance of probabilities.
And I think what people need to understand is that when you change interest rates, it sends shockwaves throughout an economy. Whether you hike them or cut them, it can, especially when you hike them, it can lead to job losses. So every time they think, okay, let's hike, they're potentially causing all these job losses or contractionary issues, which they've got to obviously think about. So it is a very pressured job. Not a job that I'd quite fancy at the moment.
No, and it's such a complicated. You think the US economy, the most complex in the world, the largest in the world, the most important in the world. You know that your decisions affect not just the US but everybody else. There's that famous quote from, I think it's the Treasury Secretary in the 70s, or one of the Treasury Secretaries says, "The dollar is our currency, but your problem." I think he's speaking to the rest of the world.
Or when the US sneezes, everyone else catches it.
Exactly. So what they do now has reverberations around the globe that will mean that people not living in the US and no connection to the US will have their lives potentially affected by this. And what, of course, we talk about what it means to the economy. What does it mean for the stock market? What happens after you cut rates? Where do we see markets going? We're back at record highs essentially for the Dow and the S&P. Yeah. Where can markets go from here?
It's an interesting one. I think, naturally, if we see rates come down above expectations, if there's that 50 basis point cut, which is actually, I think there's now a 40% chance of it.
I think it's higher than that now. I think it's 59 as of this morning on the CME's Fed Watch.
Wow.
You've gone back. It's been a really interesting week, actually. Sorry. We've gone from expecting it to be 50 basis points about a week ago. Then it was back to 25. Then as of Friday, and I think it was Bill Dudley and various sort of hints in the Wall Street Journal, Financial Times saying actually they were looking at the 50 basis point. It's suddenly come back again, and it's viewed as the most likely because suddenly we've gone from a month ago where it was, the market's very worried about US recession, and you've got what the Bank of Japan's doing, and they meet this week, by the way, as well, just to add to the fun. But it's people calling for emergency rate cuts, and that, they shouldn't, if they need to cut now because it's an emergency. And suddenly we're talking about a 50 basis point cut from a Fed that was very keen to leave things unchanged for a long time. It's remarkable how quickly things have shifted.
Yeah, absolutely. The expectations are there for a 50 basis point cut, and if they come to fruition, we could see a market rally. But if they don't, markets might throw a tantrum. So it's interesting to see, and also throughout the rest of the year, I think we've got another couple of cuts priced in towards now and the end of the year. So it's what happens with those cuts, whether we get we could get a 25 this week, and then we could get a 50 later on. We're not sure. So I guess it's what happens in terms of what's priced in. Do we get what's priced in, or do we get random positive events? Cuts higher than, and then markets cuts higher than expected, and then markets really, really enjoy that. That's, I guess, what where the buoyancy could come from. In the short term.
The messaging around it as well, because if they'd done this a month ago, there would have been a lot of worried people out there. But I think if they get the messaging right this time, it's we're not worried about the economy, but we think, given how far inflation's come down, we've got the room to maneuver, and it's a 50 basis point cut, everybody, but it's not because we're worried. It's because we think the economy can continue to grow, and we're not about to spark inflation again, because they don't want that particular genie to get away from them.
I think they'll be very careful with the recession rhetoric, because I think they don't want to paint a extremely rosy picture, an unnecessarily rosy picture, but they'll be cautious because they've obviously seen this data well before we did in terms of the revisions to the job data and the slowing employment figures, and they'll be taking note of that and thinking, we don't want to give too much over optimism. So it'll be very interesting to see what they say, and then we can discuss it in the next Beauchamp and Bright for sure.
Yes, we'll certainly see what they've done, because there's also kind of about where markets move in the 100 days afterwards. Because if we're living in either a world where the economy will keep expanding, or we're living in a world where we're about to go into recession, I probably tend to the former. But if you cut rates into an expanding economy, then you tend, unsurprisingly, to get a market that expands because earnings keep going up, because companies keep making money. So that's good for the stock market. If you cut into recession, then it's a whole different ballgame in the next 100 days, and more unlikely to see heavy losses. But the problem is with that, you only know in hindsight.
Of course.
So come back to in 18 months' time, we can say, oh, they cut rates into recession. We know what happened then, or they cut rates and the economy continued to expand.
Yeah.
And of course, there's the election. We can't not talk about the election. If they don't cut now, the next meeting's November. I think, is it the day before?
I think so.
The election?
Yeah. I think there's a lot of mist and cloudiness at the moment in terms of what to expect. It's an interesting period, and I think it will be very interesting to see what happens and what the figures come out as, in terms of the economy and in terms of how they proceed with rate cuts.
Precisely. So with the expectations, just to sort of reiterate, we are expecting, I think, well, we know the Fed will cut rates. I think it's fair to say it's 100%.
Yeah.
It's now the question of 50 or 25 basis points.
Yeah.
And it looks like the market is almost pricing in 50 at this point, 60%.
What's your hunch saying?
I still, the job of a central bank is almost to be cautious.
Yeah.
So I wouldn't be surprised if they still go for 25, but it's much more finely poised than even it was a week ago.
Yeah,
I
I
think.
agree. I'm also in that mindset. I think Powell and his team won't want to be too optimistic. I think they know they need to start cutting based on what they've said. But I think, we might see a 50 basis points hike, but I think 25 basis points seems safer.
Yeah, I think that's what we're looking at. We should move on and talk about something else at record highs, not stocks for change, but gold.
Mhm.
Everyone's favorite yellow metal, or the barbarous relic. I forget who called it the barbarous relic, but gold back at record highs. Why?
Well, I think there's a couple of reasons. I think the geopolitics has been very, as I mentioned before, quite concerning with what's going on in the Middle East and Ukraine for the past couple of years. So that's, gold is a safe haven asset. So we've seen growing demand for gold based on that. We've also seen yields come down this year, which is, reinforced, I guess, demand for gold because gold is obviously, doesn't generate any cash flows. So when we see yields come down for bonds, it is actually supportive for the gold price to rise.
Yeah, and as an investment portfolio manager, what would you, when someone says to you, I want to invest in gold, what's the discussion that you have around that?
Well, it's an interesting one. I actually used to not really be a fan of gold at all.
Well, I'm not at all. I have to say I don't understand it really.
I'm saying that wearing a gold necklace actually, but I'm not really wasn't traditionally a fan of gold in portfolios because I always thought, and what I was always taught by sort of mentors was the best kind of assets are ones you can value with cash flows on a fundamental level. And obviously gold doesn't generate any cash flow. It
just sits there.
It sits there. It's got no intrinsic value apart from looking nice. But I spoke to a colleague a few years ago, and this actually changed my opinion on it. And he taught me about the suit to toga ratio of gold, which is you could buy in Roman times. I mean, the toga was a really posh bit of outfit for Roman men and women back in Roman times. And with an ounce of gold, you could buy a very nice toga. With an ounce of gold now, you can buy yourself a very nice top of the range suit. So his argument is that gold has kept its value because you can buy the top of the range clothing then, and you can also buy it now. My opinion on that is, yes, there is definitely some elements of truth to that. But what I like about gold is it generally is not so correlated with stocks and bonds in a portfolio. Obviously, this year we've seen some correlation to stocks, everything's sort of flying. But on the whole, gold acts as a very nice diversifier. So it is good to have in a portfolio, from my experience of managing these portfolios. And we actually have access to it through an ETF. So it's actually an ETC. It's an iShares product which tracks the price of physical gold. So we're not actually owning any physical gold bars in our portfolios. We hold it through an exchange traded product, and it tracks the spot price. So it's a really efficient way to get access to gold prices and gold movements. And obviously, there's some ESG concerns about gold, which I understand. And there is a product which is run by the Royal Mint, actually. I know some of the team over there, and they have a sustainable gold ETF, which is the ticker RMAU, which uses recycled gold. So if there's any ESG conscious clients, it's a good way to get gold without the carbon intensity.
And it has been a really good investment, actually. You can knock it and say, oh, it's a leftover of a different world. It costs you money to store it if you hold it physically. But actually, if you look at the bull run from 2000, 2010, and then again from 2016 onwards, it's been a really strong performance. So it does make sense to have in your portfolio. It is going up in price, and the definition of a good investment is one that goes up in price.
Definitely,
so in that sense, you can't really fault gold. It's been boosted hugely recently because of a huge amount of buying from China, central banks, Chinese buying gold because of its property as a store of value, its perception as a store of value. So there's certainly the demand for it, which if you're looking at it as a stock, stocks go up on the basis that people want to buy into it, but there's a demand for it. So in that sense, it is doing really well.
Absolutely. I think it is done incredibly well. And it's just when we're managing a multi-asset portfolio, one rule I sort of learned and was taught was we need to prepare a portfolio. You have a base view of what you think is going to happen, but you need to prepare yourself for different opportunities, because if you get your base view spot on, of course your portfolio is going to go through the roof.
Yeah,
but
if you get it wrong,
then you'll be devastated. So you have to prepare for quite a few scenarios. So even if we think stocks are going to absolutely fly, we still have to have diversifiers in there, and gold acts perfectly for that.
Yeah, it's always good to have that diversification, a hedge against
definitely
the stuff you don't see coming, or the things that you don't realize that you don't.
Yeah. And gold has got this sort of historic reputation for being that, diversifier, and just this historic thing which people have always invested in for thousands of years.
Yes, exactly. And of course, there's not just gold or the commodity itself, but there's gold miners, which you might argue is another interesting way of playing it, because it brings in dividends, for example. So there's another way of looking at it as an investment.
It's I remember speaking to a colleague about this a number of years ago, and it's almost leveraged gold when you're buying the miners. Because of
where they do well, they do really well, and when they do badly,
absolutely. So definitely worth noting that if you decide to go in a sort of gold miners fund over a gold ETC.
Yeah, exactly. And of course, you've got the big miners where it's, say, part of their output. They don't just dig for gold, they dig for other things. And then you've got the small cap miners, like any small cap stock. You've got that huge amount of risk that they could find something, they could find nothing. So
definitely,
whatever you're doing, it's important to spread that risk around. And so I think it makes sense to look at gold for all its sort of oddity. It's just a metal, it just sits there. It is still a very useful part of your portfolio.
Absolutely. And we're very happy that we kept it. And Martin and I, who Martin and I, who obviously we had on last week, we've had obviously discussions about whether we should take it out entirely, whether we should add to it, whether we should trim it. And I think our consensus has been, particularly with the geopolitical issues in the Middle East and Ukraine, is to sort of always have a position in it. And we decided to keep it in when we did a rebalance last year. And then the October the 7th attacks happened in Israel, and gold really helped stabilize the portfolios when equities were selling off after that.
Yeah, that's actually been a fantastic run, really, for gold. The last 2 years, particularly, very, very strong. And it takes us nicely to sort of, where are we now in markets? We're recording this before the Fed, so there's a lot to play for, if you like. But where do you think we are in markets at this point in time as we head towards Q4 with scary rapidity?
It's interesting. I think markets are optimistic, but also optimistically cautious at the same time. They're waiting for the next course of action. Obviously, we had something really spook them, just over a month ago with the carry trade and everything related to that, and we saw quite a fairly aggressive sell-off, which picked up nicely. But as you said, we're at record highs again, and I think it's an interesting scenario. It's now all eyes on the Fed. That's kind of how I see things going on, and how if we continue to see corporate profits and corporate earnings grow, and if we see data deteriorate, and how strong the data is coming out of the US, and that I think will determine sort of the markets going forward.
It wasn't a bad earnings season by any stretch of the imagination, was it, in the US? They did really quite decent growth. I think 5.3% in revenues. I was looking at it last week.
We haven't had a bloodbath, which I think a lot
No.
of people expected post rate hike, which is quite interesting.
Yeah, the way that the US economy, and also just to go back to the Fed, is almost an argument for why it doesn't matter as much as it used to, that the US economy weathered this huge rise in interest rates. People said, oh, at the moment they hike rates this high, it'll go into recession. And it didn't. Maybe that's because people are on these 30-year mortgages. Maybe it's because companies were simply well prepared, that the growing economy cushioned that anyway. It's almost an argument to say, well, if it didn't matter that when they hiked rates, maybe it won't have the same effect this time around when they cut rates.
I have a friend who moved to New York about 2 years ago, and I was speaking to him on the phone over the weekend, and he said, Aaron, you don't understand the strength of the US economy until you live here. So he said that it is just incredibly strong, and you get this sort of feeling when you're there about how strong consumerism is there.
And I think the question for markets is how much of the gains can still be borne by tech.
Yes.
You've had a tech-fueled bull run that's contributed. If you look at the average return for the stocks, most stocks have underperformed the S&P itself this year. So it's been driven by a small number of companies, which actually is how indices do tend to work. I get quite het up when people talk to me about, it's only a few companies driving the market, therefore it doesn't really count. Well, it's still gone up. But that's how indices tend to work. The biggest companies are the most important ones. They drive the biggest returns.
I mean, it's worth noting how much exposure one has to these companies in their portfolio, and whether it's worth exploring instruments or securities such as an equal weight just to shield themselves if there is a sort of correction in the tech side of things.
Yes, I think it brings risk, doesn't it, as well? If you have, as we've seen, actually, the Nasdaq 100 is still below its record highs, whereas the Dow and the S&P both back at record highs. So there's a sense that maybe others are taking on the burden, which from an investing perspective, if you're long, from a trading perspective, you want to see anyway. A market that goes up relentlessly without any declines, and one that is driven purely by a few companies probably isn't going to be stable forever, but it is almost a feature rather than a bug of markets. But as we've got Q3 earnings, amazingly, it comes around so quickly. Starts, I think, 11th or so of October for JP Morgan. So we're back into that very, very quickly, which is, if you like, the bridge between the two Fed meetings. Then you've got the election. But there's a sense that we still have room to grow.
Definitely. And I think also on sort of the fixed income side of things, you'd expect bonds to rally well if we get, rate cuts, and also rate cuts which exceed expectations, I would say. So that's an interesting area of the market, and an area of the market we've made sure we've got plenty of exposure to in our portfolios to benefit from rate cuts.
Yeah, and we came into the beginning of this year thinking there would be a lot of Fed rate cuts in the first half of the year. We didn't have any.
Yeah, well, interestingly, Martin and I, we were always very sort of hawkish on that. I mean, I remember I started IG 2 years ago, and rate cuts were being forecasted for 2023 then, towards the end of 2022. And Martin and I remember sitting down with him, and we both thought, there's no way there's going to be rate cuts. So we played that quite well, and we're happy that we didn't position ourselves too optimistically in the fixed income side for rate cuts, sort of on the longer dated bond side of things. We were much shorter on a shorter duration last year, which was beneficial for us. But yeah, it's now clear as day that if you listen to what Jerome Powell is saying, that the cuts are imminent, and we await for Tuesday.
Yeah, it would be potentially very, very interesting. We've seen volatility come back down again from where we were in August, which is, I think, a sign of things you expect to get the occasional pullback, and August duly delivered that. If you're looking at it from a seasonality perspective, I'm a big fan of looking at the average performance for a year. There's a window from mid-September until late October where the market can have another bit of a sell-off, or it's traditionally weak. So there's that potential. Maybe there's post-Fed disappointment. It's impossible to say exactly what will happen, but there's still that window.
I think that's why we love what we do, Chris. It's the fact that every day can be different.
Exactly. Yeah. And things can happen in so many different ways. You cannot simply say if the Fed does X, then you will get Y in markets. There's far too many variables. It's the same with company earnings. You can have a fantastic earnings report, and yet the stock drops.
One dodgy bit of guidance from the CEO, and you can get a crash in the stock. Company X has grown its earnings significantly higher than expectations, but we're concerned about this minor part, and the stock crashes, for argument's sake.
Which takes us nicely on to questions from home. Talk about back to gold slightly. Why is it so popular? Why is gold? We probably did cover this to an
Yeah.
extent, but why is it so? Why does it retain this allure in 2024 when you've got so many other things you could invest in?
I just think it's that lack of, long-term correlation to other areas of the market. It's that store of value, that traditional store of value, which has typically held its value quite well, tends to beat inflation, and it tends to be a nice hedge against geopolitical uncertainty, which equities can often exhibit quite a lot of volatility around. So it's that, I guess, that steadiness in your portfolio, which can sometimes be added.
Yeah, I think, or there's that sort of handover from or leftover from history where it was currency for so
Yeah.
long, and I think that you're sort of brought up understanding that.
Yeah.
And I think
And the gold standard.
the
of
gold
course, yeah.
standard, and if there's always someone who says we go back to the gold standard, all this kind of
Yeah.
thing. We should get an economist on to talk about why that'd probably be a bad idea. And when Nixon took the US off gold in the 70s,
Yeah.
and that begins the period of inflation, off you go. But
Bringing me back to my uni days.
yes, it's a jaunt through economic history, but it's interesting how it just retains that allure, literally that allure of everybody in the way that it simply for what it is, really.
This is a question from George by email. What are the best markets to watch around interest rate decisions this week?
Well, I think the US dollar, I think it has to be the most important one. Well, we should note we have the Fed on Wednesday, the US Central Bank on Wednesday. We've got the Bank of England on Thursday, which is not expected to cut rates. They're expected to stay at 5%, although I think they're on a course to continue cutting rates. And then you get cue dramatic music, the Bank of Japan, because they were the ones that caused all the fun last month with their hikes, and they're not expected to hike rates again. I think they said something last week about, we will look at it carefully. I thought, yes, you probably should after the last time when you nearly broke things. But looking at interest rate decisions, it's the currencies where you tend to get the most obvious reactions in the immediate aftermath.
Definitely.
Around that. So looking at the US dollar for the Fed, and then if you're trading something like cable, the pound against the US dollar, it's going to be a fun week. I say that in its loosest possible term because you get
Depends
the Fed.
what side you're on.
It depends what side you're on, and you could get caught either way now. And if the BOE is maybe not as dovish on the outlook, then you get more volatility. So again, do be prepared for this kind of thing. And then dollar yen below 140 for the first time in 2 years, I think, or more against the US dollars. It's huge. It's one when trends go bad. I was thinking this morning, look at it, how dollar yen was an obvious one-way bet for so long. You just buy dollar yen because it will go up. And then suddenly, when these things stop, they never stop in a gentle fashion. It crashes down a hillside, if we can sort of hark back to falling down things. And it continues to go. And this is the continued unwind of dollar yen. And it, by the looks of it, it does. The Nikkei's recovered, but there looks to be more
just
downside.
Talking about the yen in general, just as a little side point, I met someone last year who went to Japan, and Japan's always known for being a relatively expensive country, but just given how much the yen's depreciated over the past couple of years, he said it was actually quite affordable.
Oh,
but
okay.
now it's reversing, it seems.
You see, you get travel advice on the podcast as well as discussion around investment. And then the last one, Richard from Billericay comes and says, how big of a cut do you see the Fed and be doing this year? So we're not talking about this week, we're talking about for the rest of the year. And we've got 3 Fed meetings left, I think 3 Bank of England.
If I knew the answer to this, I would, well, I think it's a very, very difficult one to answer. I think we sort of discussed this a little bit earlier. I think probably 325 basis points cuts from the Fed, or maybe 50, 25 maybe.
Okay.
What are you thinking?
Yeah, I think 25 this week and maybe 50, certainly by the end of the year, maybe in 25 basis point increments. It could arouse the ire of whichever person wins the election.
So you're thinking either 100 basis points total or 75 basis points total between that?
Yeah, I think spread over the next 3 meetings. And probably maybe 50 basis points more from the BOE. They're a little bit more cautious. They're still hedging their bets a bit. They're not moving this week.
We've seen stickier inflation in the UK.
Very much so.
Yeah, and I think that hopefully Andrew Bailey knows that. I'm sure he does. And he'll take that on board.
Yeah, and we get UK inflation as well Wednesday morning. So from Wednesday 7 a.m. it just began to
nice early print for everyone.
Yeah, quite interesting. I never quite understood why they've moved it to 7 a.m. Well, that probably makes sense, but it is a bit of a pain. So that's the questions from the floor or from listeners. Do keep those coming in. Pop them. Email them through. We can discuss them on the podcast. And then
I think it's time for On This Day.
It's On This Day. You're very excited by this one, it has to be said.
Yes. So Today is the 16th of September, just if you're listening to this at a future time. 1795, the British capture Cape Town from South Africa. Capture Cape Town, South Africa from the Dutch. 1848, slavery was abolished in French territories. I believe that this came much sooner in the British Empire under Wilberforce. I mean, I know you're a big history buff.
Yeah, so that's the 1820s, 1830s.
I knew you'd know the exact date off the top of your head. 1963, Malaysia was formed, modern Malaysia. What's quite interesting about Malaysia is it's actually two main land masses. You've got the Malay Peninsula and you've also got northern Borneo. So if you look at Malaysia on a map, it's actually two distinct land masses. I've actually had been fortunate enough to go to Malaysia in Borneo, and it's a wonderful country. So I highly recommend that. And the big one, which I'm going to try and explain in 30 seconds.
An unexpected explained in 30 seconds.
An unexpected is, firstly, this is actually two things happened on this day in 1992. Firstly, most importantly, it was Nick Jonas' birthday. Nick Jonas was born of the Jonas Brothers. But most importantly for this podcast, it was the 1992 Black Wednesday happened. And I'll try my best to explain that in 30 seconds.
Go. I'm looking forward to it.
So, the UK joined the ERM a couple of years prior to 1992. The goal of this was to try and maintain stability for the pound towards an eventual likely move to the euro. What actually happened instead was the pound began to devalue and depreciate against other currencies. Most notably, George Soros and others were very vocal about how the UK couldn't and the pound couldn't sustain its levels, and they were very pessimistic about UK economic activity at the time. Eventually, this culminated in increasing devaluation of the pound and depreciation of the pound. The crux of this was Black Wednesday, where there was a huge crash in the pound. George Soros made an absolute fortune through short positions, as did many other people who were unloading the pound on that day and dumping it on that day. And the Bank of England tried to do some emergency measures, such as hiking rates from, I believe, 10 to 15%.
Yeah, you had to move from the 10 to 12, I think 12 to 15%, by the end of the day.
And eventually they couldn't stop the devaluation. George Soros was $1 billion richer, and the UK had to leave the ERM.
And then they cut rates the next day back to 10%.
Yeah.
So you had this incredible volatility in the last 20 years, where you've seen interest rates stay at one level for years. To have that kind of move in a day.
I think it's actually one of the most significant recent events in, I'd even argue, British political history. I think this paved the way for Tony Blair's landslide.
Oh, yeah, I think so.
And also was a huge headwind for the UK joining the euro, and what could be a significant reason why we maintained our pound and the Bank of England, because I think maybe, who knows what would have happened. This is just me playing alternate history here, but could we have moved to the euro if we stayed in the ERM? Who knows?
It certainly does. I think set the marker, I think, for the next sort of 5-10 years. And if you like, it's very famous, of course, because Norman Lamont, who was Chancellor, he comes out and gives a statement. If you look in the background behind him, there's David Cameron, future Prime Minister, standing behind him as an advisor.
Running with a stack of papers.
Yes,
something
exactly.
Like that.
So it's a nice sort of foreshadowing of what's to come, really. So that is on this day. Another interesting set of events. Also Henry V's birthday, if you like, back in the 14th century. So another one for the history fans there. But that is it for the podcast for this week. Thank you very much for joining us. It's so good to see you back, Aaron.
Thank you. It's a pleasure to be back. Thank you very much for tuning in, everyone.
And if you've got any questions, do write them in to the podcast. Either email them or post us. I am on Twitter as well, at @ChrisB_IG. Sorry, on Twitter. X, of course. I still call it Twitter. But thank you very much, and we will speak to you next time.
Thank you.